100 companies know and do things that most other companies in the developing and middle income economies are not able to do. One of those things that they're able to do is to buy, leverage, and mitigate debt in a very special and unique way. Now, this happens because of market structures and market realities and the market enablers that are in place. Today, I want us to look a little bit at smart debt leverage. Over the last few days, we have been looking at a very unique topic titled How to Buy Business Debt. And in introducing this topic to you, we covered a number of critical talking points. For example, we looked at the issues relating to pre-qualification criteria. We look at how to predetermine whether you're buying a good debt or a bad debt. And this is an important talking and sticking point. Because very often when you, as an entrepreneur, attempt to buy a debt or buy a debt, in most cases, you cannot predetermine whether that debt is a good debt or a bad debt. And in my last two broadcasts, I have given a whole lot of justification why that is so. In evaluating this topic, just to quickly do so, we talk about cash flow projection, and we talk about smart ways and not so smart ways to do the cash flow projection. We talk about the importance of doing primary market research, the importance of doing secondary research and lean more on reliable secondary data as against outdated secondary data. And of course, we talk to you about speculative market research, and that is all about the guess game into business. You bring the guess game into business, and we actually take the guess game completely out of business. We also move on to look at market analytics. And in looking at market analytics, we talk to you about the market accommodators and the market enablers. Now, the top 100 companies that are able to generate billions, hundreds of billions of dollars in annual revenue, they have some unique enablers within their market, meaning that they have access to debt, equity, credit, and smart capital market that they are able to leverage and use in a way that most other countries, developing and middle income economies, are not able to use because these market infrastructures are not necessarily in place. We also went on to look at some of the pre-qualification criteria that you should consider when you're going to buy debt. For example, we talked about the debt principal, we talk about the debt interest rate, we talk about the debt life cycle, we talk about your monthly debt obligation, and we talk about the debt cost over the debt life cycle. And of course, some very unique topic and talking points came up there because we introduced you to the banker's perspective, and they're protecting their interests by looking for collateral. And we talk about the business owner's perspective, and we said that they should develop a new approach in protecting their mom, dad, uncle, aunt, and friends' equity or asset that they may put upfront as leverage to gain access to capital. So we went very deep into that kind of analysis. Today, I want to shift the little goalpost just a little bit, and I want us to talk now. Now you have accessed that capital, you access debt. Is there a smarter way to leverage that debt? And that's what we're going to talk about today. In another broadcast, we'll look at how to mitigate that, because these are all important systems that you need to learn. And of course, the top 100 companies, believe me, they understand this and they use all of this to their advantage. My role is to present you this information so as to ensure that moving forward as an entrepreneur, you're able to make better business decisions. So today on the smart debt leverage, there's a couple of things that I want us to talk about. We will talk directly to how to access and leverage debt back into your business, how to access and leverage debt into public and private equity, and how to access and leverage that into performing assets. As an entrepreneur, as an innovative or creative thinker, as one who is thinking how to cash flow maximize, these are important systems, important platforms, and talking points for you to start to get familiar with. The biggest companies across the world, they are leveraging some of these systems. However, just before we get into today's program, do permit me to introduce myself. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the self-published best-selling author for several books, including Manager's Toolkit and Billionaire Quotes. I'm also the author for 10X Branding and Marketing Blueprint, The Psychology of Doing Business. You don't want to miss out on this book. So because of this, I want to ask you to like, subscribe, and share. If you're in business and you find this content interesting, I want to ask you to like, subscribe, and share. Press that notification bell so you will be the first to get this information soon as it's out. And just let me give you some nuggets of some of the key takeaway with this book, 10X Branding and Marketing Blueprint. In this book, you're introduced to what is known as the 5 ecosystem of successful businesses. And you need to understand the 5 ecosystems. You understand this, and I promise you that your approach to manage your business, to diversify and scale your business and integrate your brand across region, across the world, it will expand the way you think, and it will empower you with new systems and new techniques and quicken your steps to attain the level of success that you want to attain. But that is not all. You will also be introduced to the system value proposition 101. And every single business owner needs to take the time to understand what system value proposition 101 is all about. This introduces you to important concepts like brand traits. And your brand traits is all about your value propositions, your corporate culture. You need to know it, because without you understanding your corporate culture, without you understanding your value proposition, it is hard for you to do sales and marketing. It is hard for you to build visibility, all right, at a range of other things. So this is absolutely necessary. And if that is not enough, you will be introduced to a very unique thesis in that book that we call the 10X Wealth Leadership Blueprint. You don't want to miss this book. So I'm giving you 3 reasons why you should like, subscribe, and share. So when that book comes out, you will be the first to know and get this book in your hands. So welcome once again to today's program. Today we are looking at how to buy and leverage, smart ways to buy and leverage debt. Under today's heading, I will be looking at how to leverage debt into business, things that you should be thinking about, how to leverage debt into private and public equity, and how to leverage debt into performing assets. So stick with me, let's go through this right now. What are some of the considerations that you should be making when you're attempting to buy business debt? I want to call to your attention that the more successful businesses in the world, they understand something that we call the break-even point. And as I talk about the break-even point, it's important for you to know that most of these businesses, they have a 5-year break-even point. All right, and you need to know this. What a 5-year break-even point means is that everything leading up to that 5 years, they may have a deficit cash flow. A deficit cash flow means that they're having a negative cash flow. Can your business be sustained for the 4 to 5 years with a negative cash flow? And as I go into today's program, I will bring that out to you much clearer. And this again is the reason why many excellent brands, innovation falls off of the market long before you get to that 5 years. All right. And let's go into this. Let's try to dig into this a little bit. First of all, you take a debt from the DCM, the debt capital market. And this simply means that you have monthly amortized, collateralized debt obligation. So as soon as you start to make profit, or even before you start to make profit, you have this obligation to deal with. And if you don't understand what you're doing when you were taking debt to pump it back into your business, you could be bitten in places that you don't want to be bitten. You could be hurt, and you can hurt your mom, your dad, your uncle, your aunt, your friend. And those are things that you don't want to do. So you need to think ahead, see beyond these problems, and know how to take informed action to mitigate these realities. So as you think about buying a business debt, it's important for you to consider the smartest way to buy those debt. And you need to ask yourself, is getting into business, taking that debt and pumping it into business, is it the best thing to do? You have a 5-year break-even point. Break even, not positive cash flow, break even. Are there cases where you may be able to cash flow before the positive cash flow before that break-even point? Yes, they are. But do you understand all of the appropriate system that you need to use to be able to achieve it? All right. And to achieve it, it's going to be high cost. But there are ways in which you can do it. And of course, we at Global Capital Inc. and 10X Branding and Marketing LLC, we're here to provide you with those kind of expertise to really help you to make an informed and educated decision as to how to do these things, how to buy debt, how to leverage debt, and how to mitigate that entire process. You owe it to yourself. You owe it to your investors to get enough skin in the game to understand how the game is played. So the first thing that you have when you must be thinking about, first thing, is the 5-year break-even point. And to take into consideration that you have monthly collateralized, amortized debt obligation. But that's not the only thing that you have to consider. You have hired help. You have your marketing and public relation and finance department and customer service department, distribution, value chain. You have a team of persons that are working with you to help you to achieve the business strategic objective. So there will be a cost attached to this. And let's take, for example, that you're the kind of entrepreneur that wants to make a first strong and lasting impression on the minds of the consumers, on the minds of the potential consumers, on the minds of the public. So you invest a whole lot into building up an attractive storefront. You have a unique building and a unique storefront. All of these things cost you hundreds of thousands and possibly millions of dollars. All right, in the US standard, it's going to be hundreds of thousands, probably in Caribbean dollars, it's going to cost you millions, hundreds of millions of dollars. All of these things you need to take into consideration, because as you generate income, within the 5-year break-even point, you have overheads, monthly overheads to be dealing with for the operationalization of the business idea. Now, these are very, very important things that I want to encourage you to really take the time to consider. Now, we look at a couple of things. We look at the debt repayment. We look at the building that unique, storefront. There's going to be a cost. It's going to cost you a lot of upfront capital, and we talk about the cost for human resources, the cost for hiring. But you also have a cost for marketing and introducing your value proposition to the public. So when you take all of these costs into consideration, it is a clear reason and justification why many businesses do not get to that break-even point until 5 years after. Yes, there is a way to fast-track the process, but we'll talk about that at another day. I'm helping you to see things that you should be thinking about when you're going to buy a debt. So you have the 5-year break-even point that you need to sit down, settle in, strap yourself in, and think through that process. Now, research is showing us again at Global Capital Inc. and 10X Branding and Marketing LLC out of New York, that many persons wake up, have a great business idea, and just go at it. You never take into consideration all of these realities to manage a successful business. And when you fail, you tend to feel unlucky. But you fail because you are not applying all of the essential information that is necessary for you to apply to build a successful brand. So you need to take stock of these things and apply them, accommodate them, adopt them into the normal process of business growth. So you also have 5 years of what might be called the deficit survival. You have to survive throughout this entire period. And that is again why businesses in the developed world, they are able to leverage debt, equity, credit, and smart capital within this entire life cycle. And let me give you one clear example. ExxonMobil is operating in a number of countries. Do you think that from the time that ExxonMobil started prospecting, doing the survey, they strike gold? No. Sometimes that process goes on for years, 2, 3, 4, 5, 6, 7, 8, 9 years before they actually strike the liquid gold. So they have to pump hundreds of thousands and millions of dollars into the investment process, into the prospecting process before goal is strike. And do you think from the time they strike, they're going to start a positive cash flow? So they have to sustain that will, that desire, that drive to succeed in the find for many, many, many years. The possibility exists while you're doing these type of perspective that you might not even strike liquid gold. So all of your investors' capital goes down the drain. All right? There are ways to mitigate that, and we will certainly discuss that in another broadcast. So it's important for you to have a survival strategy as you get into business, that 4 to 5 year survival strategy. You need to think through this process. You need to ensure that you have these systems in place that can sustain you, all right, for as long as you need to be sustained to come out successful at the end. You see, when you have this kind of information, you're able to up-level this kind of information into your business strategic development process. It helps to remove the frustration. Success in business is not instant, but success in business, if you know what you're doing, can be guaranteed. But it requires the right information. And as I keep saying, the top 100 companies, the top 500 companies, they know things and do things that most of you are not doing. Our mission is to bring to you as much of that information as possible and to work with you to provide the mentorship, the coaching, and the support to ensure that you can apply these techniques to your life and ensure that you're going to optimize your level of success. Now, as you think about leveraging debt into business, one of the last heading that we're going to be looking at today is what we're going to call the profit margin after 5 years. I did say it. You may take a number of years to do research, to do perspective, to build up the product, innovate new services, ensure that you build out relationship with the target market. This is not only relevant to Exxon, but when you're putting a new product on the market, let us say, skincare product, you just don't put things together as a chemist and just put it out there, because if you do that and there is, negative reaction from the public, you can be sued for the last piece of clothes that you got on your shoulder. So these companies involved in in-depth research, testing, analyzing the product, testing it for a period of time, not a 1-day testing or a 2-day testing. It has to be tested for a lengthy period of time, so as to ensure that you create enough window to get feedback from the utilization of the product. Because if anything goes wrong in a particular life cycle, and the public can put the blame at your door, they will sue you. All right, so we talk about the survival rate, but I'm talking now about profit margin after 5 years. If you don't know what you're doing also, after 5 years, if you are not fully aware of what you're doing, the cycle, the growth cycle can be prolonged. The cash flow cycle can be prolonged. Because research again is showing that within this life cycle, the growth curve life cycle, the cash flow life cycle, there are many businesses out there that still have not taken the time to build up their brand traits, that still have not taken the time to build out a strong value proposition, has not dovetailed all of that into the brand visibility game plan, have not, built out the brand reach game plan, the brand impact game plan, to move all the way down to brand conversion and confidence, trust, and credibility. So success in business requires understanding these systems, adopting these systems, and applying these systems in the daily operational life of the business. And failing to do this, it can slow down progress, delay the cash flow potential of the organization, handicap the entire process. All right, so again, I want to encourage you to like, subscribe, and share if you find this content interesting. So you will be the first to get this information that we are bringing to you on a regular basis. I also want to say to you that we at Global Capital Inc. and 10X Branding and Marketing, we have a team of certified public accountants, a team of economists, a team of business consultants, a team of marketing and branding specialists, a team of legal minds who are all committed to working with you to ensure that we can give you the best advice, best mentorship, best coaching, to ensure that you get out there and you succeed in business. All right. Now, I want to move to the second heading, and we're going to be talking now about debt leverage into public and private equity. But just before I go do a deep dive here, I want to just quickly reflect on taking debt and putting it into a business. You need to think about these things very, very carefully. And this is one of the reasons why in the last two programs, and if you didn't look at it, I want to encourage you to go back and look at the last two programs. Find us on YouTube, and it's going to be easy for you to find the last two programs. We talk about before you buy a business debt, it's important for you to put yourself in a position of strength to predetermine the potential of that business to cash flow or your ability to cash flow that debt. And we give you a number of techniques that you need to do, financial projections. We talk to you about that. We talk to you about market analytics. And if you get this and you get it right, all right, it's absolutely necessary as you set out to grow and scale your business. Because starting a business, all right, starting a business, you may be reaching a point where you're getting positive cash flow, but the positive cash flow may just be 3%, 4%, all right, above your total debt cost, all right? And you must be asking yourself at every step of this game if there is a smarter way to leverage debt. All right, and let me talk about that right now as we look at how to leverage debt into private and public equity. Now, when I talk about private and public equity, I'm talking about things, of course, government bonds is going to fit into that category, but we know that government bonds throughout the world doesn't give you high dividend yield, but it is one of the most safe and secure form of investing. But let's take a little look at index funds. Let's take a little look at Reits, real estate investment trust. Let's take a little look at ETF, exchange trade funds, and draw some conclusion. Now, to take a debt and put debt back into an index fund can be one of the smartest things that you can do if you're able to do effective back-end analysis. I say this against the backdrop that any educated persons who are highly informed of the financial markets will be able to make some objective assessment. And one of the reasons I'm going to be choosing ETF, or one of the reasons I'm going to be choosing Vanguard or index funds, is because of the investment safety net that exists here. An index fund is a platform with, let us say, 100 companies, 200 companies, or something like the S&P 500. So when you put your investment into these portfolios, instead of your investment going to a single stock, it goes to a spread of different businesses. And that significantly reduces your risk of loss. Because let us suppose that is the S&P 500 and 10 companies fail, 20 companies fail, 30 companies fail. You still have 470 companies that will give you a positive dividend yield. So your risk of investment is removed. But I want us to see this beyond the positive dividend yield, because if you do the research and the analysis well, there are many of these investment platforms that may give you above 5% return, above 6, 7, 8% return. In some cases, we see persons getting 10 and 15% return on their investment. And just think about this. You have a struggling business that's going to struggle perhaps for the next 5 years or more, depending on if you know what you're doing and if you don't know what you're doing. And here's where you have $100 million asset, cash collateral, perhaps even on debt, because in the developed world, you can borrow these debt at about 1, 2, 3% interest rate. But to borrow to this rate and to perhaps put it back on the asset management in these portfolios, such as a index fund that is giving you 7, 8, 9, 10 or above annual dividend yield, it's a smart investment decision. The cost of that debt, it's about 3%, but the return is above 7, it's above 10 return. So let's put it at capital 10. Your gain at the end of a given period is still 7%. It is still 7%. And 7% on $100 million is $7 million. $7 million. And that is in passive income cash flow. And perhaps leveraging debt in this way into public and private equity as against business ownership can be a clever thing to do. I'm not saying in all cases it is, but I'm saying it's important to do the analysis, make the comparative analysis, work with your PFA, professional financial advisors, personal financial advisor, certified public accountants, economist, business advisor, to get the information if you are not in a position of strength to get that information yourself and leverage it to make informed, educated business decision. When it comes to business and cash flow, it's no game. You got to understand the game. You got to get enough skin in the game to get in the know to make informed and educated decisions. My role is just to give you some of that information. That's what we stand for at Global Capital Inc. and 10X Branding and Marketing LLC out of New York. So I encourage you to do this analysis, do this research. So instead of having a struggle in business, you can put your capital into a passive income cash flow, a safe one. All right, this is not investment advice. I am not telling you which is the safest or which is not the safe. At the right time, as you start to engage with our entity, we will do that analysis with you and ensure that we can minimize your risk tremendously. And as I said, I give you an example. You take a index fund, because of how it is structured, it minimizes your risk. It is hardly likely, even in a pandemic, that all of those companies are going to collapse. All right. It's advised that perhaps you need to take some of those big pharmaceutical companies that is out there and invest in them because they are flourishing in this pandemic. All right, they are flourishing. So these are all things to consider when you're going into the investment space, into the business space, into the money making space, and you need to put yourself in that position as trying to have this kind of information. What is another safe investment portfolio? I talked about REITs, real estate investment trust. The beauty about REITs is that most of the profit made from REITs goes right back out to shareholders. So here is where you're going to get a high dividend yield. Our REIT is not run to maximize profit for the business owners. It is run to maximize profit for the investors. And this is a unique system that was developed by, I think, the American Congress and federal body since in the 60s. All right, important data for you. And how about the ETF? What smart people have been doing in the financial world, instead of putting your investment into the S&P 500, they create a unique ETF. And ETF simply means exchange trade fund. And what it simply means is that you analyze the top performing companies and you build an ETF out of that. All right, you look at the historical track record, you look at their team dynamics, you look at their financial projections, you look at the ability of the team to take them there, the vision of the, those guys do all of this analysis. They form the ETF and they find investors to go there. Why? Because it is these ETF that will be able to ensure that you get a top dividend yields at the end of the year. And perhaps passive income dividend yield is paying you much more that you are being paid by owning a business. And you got to give all your time away when you're in the business. All right, so we're talking here today about smart debt leverage. I'm just giving you some options for you to consider. All right, so let's move to another analysis, the third analysis that we call how to leverage debt into performing assets. Now, I want to show you the top 100 companies. They're clever. All right. They don't have the excess liquidity sitting dormant. It has to go on the performance. It has to cash flow. All right. Now let's talk a little bit about how to leverage debt into performing asset. What exactly is performing asset? Performing asset is an asset that pays you multiple times. And for example, you can buy performing asset and it can give you daily, weekly, monthly cash flow. All right, it gives you assets appreciation and it gives you equity leverage. You can beat this, all right? This could be done through a second or third party, and this could be done individually. And just let me attempt to go a little deeper into this. There are investment portfolios out there that one performs well financially. And if you take the time to understand performing assets, let's take it a form of real estate, it's going to work you well because real estate is still one of the safest and still one of the smartest investment portfolios across the world. All right, across the world. Land as a state and land with buildings on it, they are one of the smartest investments across the world. And when you understand how to build these portfolios and how to leverage these portfolios, how to take debt and put debt on the asset management and under these portfolios. Once you know what you're doing, you can't go wrong. Because while this it is one of the smartest, safest platform, again, it is not necessary for everyone. Because you have to understand the market when you're buying a step. You must invest time, talent, and resources to get enough skin in the game to understand where to buy, where to cash, how to cash flow it. Because you may buy land to make it into performing asset in all of the wrong areas. So there's a number of things that you may need to consider depending on how you want to cash flow that. You need to take a look at population size. You need to take a look at demand for housing. You need to take a look at schooling facilities. You need to take a look at income. This availability of disposable income among the population. There's a number of things that you must take into consideration as you set yourself up to play in this space. My role is to give you ideas. I'm not giving you any advice here. If you want those professional advice, I advise you to reach out to our platform, Global Capital Inc. or 10X Branding and Marketing LLC out of New York, and we'll be happy to share these information with you in a direct manner. All right. But I'm saying all of this, and we can consider this program is dedicated to break old myths, because in the older days, many of us, including myself, grew up hearing to stay away from debt. Was that good advice or was that bad advice? It is good advice if you don't know how to manage debt. But it's the most stupidest thing, and I don't mean to hit on my foreparents because I went through that too, to say, if you understand how to up level debt. The wealthiest people in the world, they swim in debt. But they don't swim in debt stressing because they understand how to leverage debt portfolios. And it's important that even you, the entrepreneur, even you, the private citizen who want to achieve more, to understand how to play the debt leverage and debt mitigation game. So we talked today about debt leverage, smart debt leverage. There is still another tail to this, debt mitigation. All right, because it's exciting to get into debt when you know what you're doing. But again, if you don't know how to mitigate that, something that you don't want to may come and bite you where you don't want to be bitten. All right, so today we started off by recapping on the concepts that we looked at over the last few days. We looked at how to predetermine if you're buying a good or bad debt. We talked to you about cash flow projection. We talked to you about market analytics. We talked to you about the pre-qualification criteria. We went into a number of different of those pre-qualification criteria. We talk about balance sheet. We talk about cash flow. We talk about interest rate. We talk about debt life cycle. We talk about debt cost over the debt life cycle. Today, we introduce you to a new concept, which is the smart debt leverage. And we had three headings that we just finished looking at. And what we looked at today is how to leverage debt into business, how to leverage debt into public and private equity, and how to leverage debt into performing assets. I trust that you find today's program interesting. And if so, again, I want to encourage you to give it a big thumbs up and also continue to like, subscribe, and share. So you will be the first to get this content that we bring into you on a regular basis. And you will certainly be helping us to reach other persons. You will help us to fast track that algorithm and reach other persons so we can also transport this body of knowledge to them. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the self-published best-selling author for several books, including Manager's Toolkit and Billionaire Tools. I'm also the author for 10X Branded and Marketing Blueprint, the psychology of doing business, and you don't want to miss out on this book. This book has transformational information. We have studied the top 100 companies in the world, and we are bringing to you a lot of those techniques that they are using to build out their corporate culture to achieve large and life impact on their workforce, their target market, the general public, and on the cash flow and potential of their operation. Many of these companies that we are talking about, they walk away in annual revenue in US standard above 6 billion US dollars. At the top level, you have some of the top performers are earning above 200 billion US dollars. Do you want to learn some of these tricks and techniques? Keep looking. Like, subscribe, and share. See you in the next broadcast. Be blessed.